Does it matter when you adjust position size? This is Bill Scheid from the Systems Lab, and in this video we're going to run a test to answer that question. We're going to use the same PRX system configuration running on 3-minute bars. We'll have identical trades, identical fixed risk percentage, but a different adjustment cadence. So method A, we're going to adjust our position sizing weekly. We're going to set it on Monday morning at 1% of the week start equity. We're going to use that position sizing for every trade that week, and then we'll adjust it again the following Monday based on the new equity. For method B, we're going to adjust position sizing per trade. So we will compute the position size before every trade. It will also be 1% fixed risk, but it will always be 1% of the current equity, not the week start equity. And the equity changes after each trade will flow into the next size. So let's take a look at an equity curve comparison between these two methods. Now, both of these equity curves we're going to look at run on the same 175 backtest trades from the same 3-minute PRX configuration. Both start with a hypothetical 100,000 in capital. Both use 1% fixed risk position sizing. Neither include slippage or commissions. The only difference is when the position sizing resets, just like we talked about. And when we look at the equity curves, we see that they are nearly indistinguishable. There are actually 2 lines on this chart, but they are right on top of each other. So the weekly method and the per trade method line up pretty much exactly. And we chose this period because there's a little bit of everything. There's some flat, there's some up, there's some down, there's some up, there's some more down. And we wanted to make sure that we had a representative sample of different phases of the equity curve moving in different directions. If we look at the numbers and compare the weekly versus the per trade adjustment, we see that on a $100,000 account, after 15 months of trading and 175 trades, the two methods finished within $3 of each other. So we have a very, very close outcome. Now, why do the two methods produce the same results? 3 things have to be true at once, and they are in the analysis that we're looking at here. So first of all, risk per trade is small relative to equity. At 1% fixed risk, equity barely changes between adjustment points. Even a 1R loss reduces the next position by only 1%, and it's really too small to compound differently across reasonable adjustment intervals like the ones that we've picked here. Number 2, trade frequency is moderate. This configuration that we picked for this analysis has about 12 trades per month, and the equity moves between weekly resets are typically only a handful of R, which translates to dollar position sizes within a few percent of each other. And number 3, no streaks of huge winners or losers. Methods diverge most when one trade or short streak materially changes equity, with expectancy near 0 for this particular backtest window and a max single trade loss capped near 1R. The equity curve doesn't move enough between resets for the cadence to matter. Now, let's look at when the choice would actually matter. And these would be cases where the weekly versus the per trade methodology does change the outcome. So first of all, if you had risk above 3% per trade, at higher risk, single trade results change the equity meaningfully. A 1R loss on a 3R system reduces the next size by 3%, which compounds differently across many trades. Next would be long streaks of correlated trades. So for example, if 5 trades all hit their stops for a full 1R loss in a row, per trade sizing has already cut the size 5 times. Weekly sizing would keep it the original size for the whole week. The next case would be heavy trade frequency. If you take, let's say, 30 plus trades per week, weekly position sizing means you carry a stale position size into the second half of the week after meaningful equity moves during the first half of the week. And finally, asymmetric winners. Systems with occasional 5R to 10R winners benefit from per trade sizing during runs because each subsequent winner is sized off the larger account. Now, if your system fits any of these conditions, the choice of adjustment cadence is definitely worth you running your own backtest and your own analysis. So what does this teach us? What are some of the takeaways for us as systematic traders? Well, first of all, don't optimize what doesn't matter. Time spent debating weekly versus per trade sizing is time that you're not spending on choices that actually move the needle, like system rules, like equity curve filters, like execution quality, mistake analysis, that kind of thing. The second is operational simplicity has real value. Weekly position sizing is easier to track. It's easier to explain if you are teaching or if you have other stakeholders, and it's harder to mess up. There's just fewer chances for making mistakes. So when two methods produce the same result, the simpler one wins. And finally, test your assumptions on your own system. The results that we've looked at here hold for a configuration of PRX using 3-minute bars at 1% risk. They may hold for similar strategies, not guaranteed, but they may. But if your risk percentage or trade frequency is materially different, then you'll definitely want to run a similar test yourself before making any assumptions. This is Bill Scheid from the Systems Lab. Thank you very much for watching, and happy trading.